A budget that accommodates many levels of production volume is a flexible budget. That is true. Flexible budget can be revised for any level of activity within the relevant range. So this is true. Zero-based budget is wrong because zero-based budgeting involves justification of all the expenses for the coming budget period. Cash budget is wrong because cash budget is prepared after all the budgets are prepared. This has nothing to do with production. And again, sales budget that do not adjust for the level of production. Sales budget do not forecast production. So A is the correct option. Next. The basic difference between a master budget and a flexible budget is that a master budget is only used before and during the budget period, and flexible budget is only used after the budget period. This is wrong. Both master budget and flexible budget, they can be used anytime, maybe during or after the period of budget. For an entire production facility, and flexible budget is applicable to single department only. This is again wrong. This is wrong. Flexible budget can be prepared for many levels of activity, can be prepared for many departments, not just for a single department. So this is incorrect. Based on one specific level, that makes sense. Basic difference between the master budget and a flexible budget is that the master budget is based on one specific level of production. That's why it's called the static budget. Master budget is also a static budget, a budget for a specific level of production. This is true. And flexible budget can be prepared for any production level within the relevant range. Correct. This is the right option. Option C is correct. What about option D? Option D says master budget is based on fixed standards and flexible budget allows management latitude in meeting goals. This is again wrong. Flexible budgets, they do not allow latitude, rather they allow management to compare the actual results based upon the actual level of activity achieved. So basically, you compare your flexed budget or the flexible budget with the actual results. If you have produced 10,000 units, the budget would be revised for 10,000 units and you will compare your performance for 10,000 units versus the budget for 10,000 units. That's the purpose of flexible budget. So we got our answer is C. Which is the true statement regarding the flexible budgets? They are designed to accommodate changes in inflation rates. Well, even the static budget can be revised for adjusting for inflation. So this is not just for flexible budgets. Static budgets can be revised also. Flexible budgets are adjusted for inflation in the same way as we do for the static budgets. Which is true regarding flexible budgets. They are adjusted to accommodate changes in the activity level. That is the exact description of flexible budgets. Why not C? Flexible budgets are budgets used to evaluate capacity utilization only. This is wrong. For that we use the volume variances, production volume variances, not the flexible budget variance. They are similar to static budgets but are adjusted for inflation. No, they are not the same. Static budgets are the budgets made for a single level of activity, whereas flexible budgets can be adjusted for the changes in activity during the period. So we have got an answer B. Which of the following statements regarding the difference between a flexible budget and a static budget is correct? A flexible budget primarily is prepared for planning purposes, while a static budget is prepared for performance evaluation. This is wrong. Static and your flexible budget, they can both be prepared for planning as well as for performance evaluation purpose. So this is wrong. B. A flexible budget provides cost allowances for different level of activities, whereas a static budget provides cost for one level of activity. This is exactly what we are looking for, the right description of flexible and static budgets. What about C? A flexible budget includes only variable costs, whereas static budget includes only fixed costs. Totally ridiculous. Variable and fixed costs are part of both static and flexible budgets. What about D? A flexible budget is established by operating management, while a static budget is determined by top management. Wrong. Both flexible and static budgets, they can be prepared by any level of management. This is incorrect. Which of the following would be most impacted by the use of percentage of sales forecasting method for budgeting process, when the driver is your sales and every number is expressed as a percentage of sales. So which of these would be most impacted? Accounts payable, correct. Accounts payable is driven by activity, so sales will directly affect your account payable because sales is driven by production, production is driven by purchase, purchase results in accounts payable. So this will be the one that would be greatly affected by if we use the percentage of sales forecasting method. Mortgage payable, no. Bonds payable, no. Common stock, they have nothing to do with the level of sales directly. So we got our answer A is the right option. The most direct way to prepare a cash budget for a manufacturing firm is to include projected sales, credit terms, and net income. What about the payables? Projected net income, no. Depreciation, non-cash. Goodwill amortization, non-cash. Projected purchases, percentage of purchases paid, and net income. What about the collections? So this is partly true. We need inflows and outflows both. Projected sales for inflows, purchases for outflows, percentage of collections for the patterns of collection, and terms of payment for accounts payable. This is the complete picture. This is the most direct way to prepare a cash budget for a manufacturing firm. D is the right option. Pro forma financial statements are part of the budgeting process. Normally, the last pro forma statement prepared is, without doubt, this is the statement of cash flows. You need the balance sheet, and based upon the balance sheet numbers, you prepare the statement of cash flows. This is the last one. The last one. The cash receipts budget includes funded depreciation. You set aside a certain amount of money to replace your assets in the future. So basically, it's an outflow. As extinguishment of debt, when you repay the debt, it's an outflow. We're talking about the receipts. Interest expense, if paid, it's an outflow. Loan proceeds, yes, this is inflow. D is the correct option. Which of the following is a characteristic of a flexible budget? Flexible budget provides budgeted numbers for various levels of activities within the relevant range. Absolutely the correct option. Why not B? Allows for modification during the budgeted period. Well, this is not right, because flexible budget doesn't allow you to change any amount within the budget you want. Flexible budget is a budget prepared for various levels of activities. You can't just modify some of the numbers on the budget and not the others. Not correct. Isolates the impact of variable cost on the overall budget. This is incorrect, because flexible budget doesn't isolate only the variable, fixed cost also. Can be utilized by several products division. Well, that is true for any type of budget. Can be utilized by several product divisions, several products. Their primary feature is the flexibility, adjustment that can be made depending upon different level of activities, not its applicability on different products or different divisions. So we got our answer A. Comparing your actual results based upon 10,000 units produced and sold based on the achieving volume is possible with one of comparing your actual results with a budget based upon 10,000 units and on standard price. So flexible budget for 10,000 units versus the actual results for 10,000 units. This is a very useful comparison, and this is called the flexible budget variance. So comparing actual results with budget based on achieving volume is possible with the use of flexible budget. Rolling budget is a budget that is revised every month or every quarter as the month or the quarter ends. Master budget, it's a budget which you call annual profit plan, comprehensive budget. It is a combination of different small component operational and financial budgets. And step budget is a ridiculous option. There is no such term. So D is the right option. A plan that is created using budgeted revenue and cost, but it is based on the actual units of output, is known as, I've just told you, a budget that is based upon the actual units multiplied by the standard rates. This is called the flexible budget, and this is the one we compare with the actual results to identify different variances. So that makes B to be the correct option. Continuous budget is another name for rolling budget that is adjusted frequently. And static budget is the budget prepared for a single level of activity, and master budget is a static budget because it is prepared for a particular level of activity. When production levels are expected to increase within a relevant range and a flexible budget is used, what effect would be anticipated with respect to each of the following costs? Fixed cost per unit. As you produce more units, your fixed cost would be distributed on a larger number of units. That means your fixed cost per unit will decrease. But within the relevant range, variable cost per unit stays the same. Let's say it costs you $10 to produce a single unit. This includes direct material, includes direct labor, includes variable overhead. Every time you produce a unit costs 10, 10, 10, 10, 10, 10, 10, 10, 10, 10 within the relevant range. So there will be no change in the variable cost per unit. So that makes D to be the correct option. All of the following are considered operating or financial budget except cash budget is a financial budget, sales budget is an operating budget, production budget is an operating budget, capital budget. Basically, it's a financial budget, but it is not prepared every year. So it is the odd out all of these. So D is the right option. The cash budget provides management with information. Which of the following is not an example of information a cash budget provides? Availability of funds for distribution to the owners. Yes, cash budget provides this information. Availability of funds for the repayment of debts. Cash budget provides this information. Availability of funds for investment purposes. Yes, cash budget provides this information. But this is incorrect. The need for internal financing is wrong. Cash budget provides you information for external financing. Hence, B is the right option. Which of the following inputs would be most beneficial to consider when management is developing the capital budget? Supply demand for the company's products. That is more likely to be involved with production and sales, not with the capital budget, because capital budget involves purchase and sale of long-lived assets, capacity expansion, and so on and so forth. Current product sales price and cost. Again, it will affect your operating budget, production and sales. Wage trends on your cash outflows and your operating cost, your direct labor cost. Profit center equipment request. Yes. Acquisition of equipments, disposal of older equipments. This is what is directly related with the capital budget. Hence, this is the right option. A flexible budget is appropriate for marketing budget, direct material usage budget. True. Flexible budget is appropriate for marketing budget also, because a marketing budget varies with the level of sales, and similarly the direct material usage depends upon the level of production. It varies with the level of production. Since there is an element of variability, hence flexible budget is appropriate both for marketing budget as well as the direct material usage budget. C is the right option. Which of the following items would have to be included for a company preparing a schedule of cash receipts and disbursements for the calendar year 1? A purchase order issued in December year 1 for items to be delivered in February year 2. There is neither inflow nor outflow. Of course, there will be an outflow for purchase, but not as per the information, neither in year 1 or 2. No information is given. So at least there is no payment in year 1 because we have just raised a purchase order. Dividends declared in November year 1 to be paid in January year 2 to shareholders of records as of December year 1. There is an outflow, but it will occur in year 2. We are looking for the year 1 outflows or inflows. So this is incorrect as well. The amount of uncollectible customer accounts for year 1, it's a non-cash charge against your income, what you call the bad debts, or any allowance created thereof. So this is clearly not any inflow or outflow. Look at the option D. Borrowing funds from a bank on a note payable taken out in June year 1 and agreeing to pay the principal and interest in June year 2. So you will receive inflow by raising a notes payable on the loan. So this clearly is an inflow for year 1. Hence D is the right option. Which of the following budgets provides information for preparation of owner's equity section of the budgeted balance sheet? Sales budget feeds into income statement, and then the income statement net bottom line goes to the statement of changes in equity. So this is not the one that directly goes to the balance sheet. Neither cash budget has any role to play with the section of equity section of the balance sheet. Capital expenditure affects your assets and liabilities, not equity. Budgeted income statement, yes. The net number on the income statement is reported under the retained earning column on the statement of changes in equity. So this is the one that will affect the owner's equity section of the balance sheet. D is the right option. Okay. The benefits a company could realize from improved cash budgeting include displaying the cash effects of the master budget on the actual cash inflows and outflows from operations. This is an advantage. This is the benefit of cash budgeting. We can display the cash effects of the master budget on the actual cash inflows or outflows from operations, determining when additional sources of financing, either short-term or long-term, are necessary, and planning cash expenditures with cash availability. This is also one of the benefits of setting up a cash budget. The optimal use of trade credit. This is true as well. We will neither grant an extended credit nor we will offer very limited credit period so as the customers might go elsewhere for their purchases. So this 1, 2, 3, they are all the benefits of drawing up your cash budget. A firm develops an annual cash budget in order to support the preparation of its cash flow statement for the annual report. This is again wrong. Cash budget is not used to support the statement of cash flows or the balance sheet. Ascertain which capital expenditure projects are feasible and which capital expenditure projects would be deferred. That is the part of capital expenditures, and we analyze whether a project should be taken on or not based upon its NPV or IRR. Wrong. Balance sheet, balance the non-cash and cash activities of the company. Again, this is wrong. Cash budget would not be used to support any balance on non-cash and cash activities for the company. Wrong. What about D? A firm develops an annual cash budget in order to avoid the opportunity cost of non-invested excess cash and minimize the cost of interim financing. We want to know when we run out of cash so that we make suitable arrangements for financing, and when we have surplus cash we can put it somewhere to generate some return. So we neither want to hold too much cash because it will involve opportunity cost of non-invested excess cash, and at the same time we want to minimize the cost of interim external financing. We can arrange the funds within the business operation by collecting money from our receivables quickly, running down our inventory. So this is exact reason why do we develop annual cash budget. The cash budget must be prepared before you can complete the capital expenditure budget. This is wrong. Capital expenditure budget must be done before any cash budget, and mostly it is prepared for 5 or 10 years in advance. Forecast balance sheet. This is true. This is true. Cash budget should be prepared before we can complete the forecasted balance sheet. This is the correct statement. Production budget, wrong. Production budget is the first budget we set up after the sales budget. So this is the budget we need for purchase, for variable overheads and labor. This is incorrect also. And forecasted income statement. Income statement, it can be prepared before we develop any cash budget. So this is wrong also. CAB Incorporated, a small retail store, had the following results of operations for May. The budget for June and July are also shown. Actual sales May, June and July, budgeted sales, cost of sales, gross margin, other cash expenses, and we have the operating income for your May, June, for the month May, June and July. Sales are collected 80% in the month of sale and the balance 20% in the month following the sale. The goods contained in cost of sales were purchased in the month prior to the month of sale, and vendor payment is in the month following the sale. Right. So means if you sell goods in June, 80% of this amount is collected within June, 20% in next month. And regarding the purchase, the goods that we sell in June, we purchase it in May, and the payment for these goods is made in July. That's what the story tells us. All other cash expenses are paid in the month of the sale. The amount of cash collected during the month of June. How much cash should we expect to collect? Now, this is the figure for sales. In June, 80% of this will be collected within June. So it's going to be $32,000. And 20% of June sale will be collected in July. We are not interested in July. What about the sales in May? What you sell in May, 80% is collected within May. Now you're going to collect 20% of this amount, which means 42,000 multiplied by 20% gives you 8,400. So adding these two inflows will give you a total of 40,400, and I believe it matches nicely with your option B. Orion Corporation is preparing a cash budget for the 6 months beginning January 1st, year 1. Shown below are the company's historical collection pattern and the budgeted credit sales for the period. 65% collected in the month of sale, 20% month after sale, 10% second month after sale, 4% third month after sale, and 1% remains uncollected. And this is the figure for credit sales, Jan, Feb through June. The estimated total cash collections during April from account receivables would be, during April, please mind it. Now, what you're going to do, in April, you will collect 65% of sales. What you sell in March, 65% is collected within March. Now you're going to collect 20% of this amount. What you sell in Feb, 65% is collected within Feb, 20% is collected in March, and now you will collect 10% of Feb sales in April. And finally, what you sell in Jan, 65% in Jan, 20% in Feb, 10% in March, and now we will collect 4% of this amount. So I'm going to calculate these 170,000 times 65% plus 190,000 times 20% plus 185,000 times 10% and 160,000 times 4%, and that gives me a total of 173,400, and which perfectly matches with my option C. Turnbull Company budgeted sales on account of 120,000 for July. This is the sales for July. On account means credit sales. 211,000 for August and 198 for September. Collection experience indicates 60% of the budgeted sales will be collected the month after the sale, and 36% the second month, and 4% will be uncollectible. The cash receipts from account receivable, to those we have sold goods on credit, that we should expect to collect in September. Let us write this down. July, August and September. 120,000 is the budgeted sales for July, 211 for August, and 198,000 for September. So what you're going to collect in September, let's say this is the collection bucket. You're not going to collect anything from September sale. It will start collecting from October. What you sell in August, 60% of this will be collected in September. What you sell in July, 60% is collected in July, 36% will be collected in September. So 211,000 times 60% plus 120,000 times 36%. So the total collection is going to be 169,800, and that is A. Our company forecast first quarter sales to be 10,000 units, second quarter sales to be 15,000 units, third quarter sales to be 12,000 units, and fourth quarter sales to be 9,000 units. And the selling price is $2 per unit. Fine. Past experience has shown that 60% of the sales will be in cash and 40% will be on credit. All credit sales are collected in the following quarter and none are uncollectible. What amount of cash is forecasted to be collected in second quarter? First of all, you need to convert these units into the sales dollar by just multiplying each with 2. So your dollar sale is going to be $20,000 in quarter 1, $30,000 in quarter 2, and $24,000 in quarter 3, and $18,000 in quarter 4. Now listen, 40% will be credit, 60% cash. We are specifically concerned with the second quarter. So what you will have in quarter 2, you will have 60% of quarter 2 sale immediately available made to you, right? Because that's the cash sales. So it's going to be 18,000 cash sales. It further says for the credit sales, which is 40%, it is collected in the month following the quarter, and none are uncollectible. So which means remaining 40% of the quarter 2 sale will be collected in quarter 2. We are not interested in quarter 2. What about quarter 1? 60% of quarter 1 sale is collected within quarter 1 as a cash sales. Remaining 40% is collected in quarter 2, which is going to be 8,000. So it means a total of 18,000 and 8,000 is going to be 26,000. That makes C to be the correct option. A company's controller is adjusting next year's budget to reflect the effect of an expected 5% inflation rate. Listed below are selected items from next year's budget before the adjustments. Total salary expense 250, health cost 100,000, depreciation expense 65, and interest expense on 10 years fixed rate notes 37,750. After adjusting for 5% inflation rate, what is the company's total budget for the selected income items before taxes for the next year? Now, total salary expense, it requires adjustments for inflation. By multiplying it with 1.05, it will be 262,500. Health costs requires adjustment for inflation. It will be 105,000. But depreciation expense requires no adjustment for inflation. It's a fixed charge, and of course we don't need to revise this interest expense also. It is not affected by inflation. If you add all these, you get 470,250. That makes A to be the correct option. Okay, now here we have a very long question. Look at this. It goes on and on and on. I told you, if you see a question like these, you just first need to see what exactly is required. It says the amount of cost of goods sold that will appear on company's pro forma income statement for February. Cost of goods sold for February. So what we need to see the sales for February, that is $650,000. And we need to see what is the percentage for CGS. It says Karmi's cost of goods sold averages 40% of the sales value, and that's all done. Done. Just these two pieces of information. Cost of goods sold is just 40% of sales, and that means 260. Finish. Your cost of goods sold for February is 260, and that perfectly matches with your option C. Ryan Company projects the following monthly revenues for the next year: Jan, Feb, March, April, May, June, and July through December. Ryan's terms are net 30. No discount. The payment is to be made within 30 days. The company typically receives payment on 80% of the sales the month following the sale, and 17% is collected 2 months after the sale. Approximately 3% of sales are deemed bad debt. What amount represents the expected cash collection in the second quarter of the next year? Second quarter, that means how much cash you will collect in April, May, and June. So let's say if this is the collection bucket, what cash you're going to collect within April, May, and June. Remember, April, May, and June cash collection. What you sell in June, you won't collect anything of this in this 3 months period in the second quarter. What you sell in May, yes, what you sell in May, 80% of this will be collected within this 3 months period. What you sell in April, 80% of this is collected in May, and 17% of this will be collected in June, which means we will collect 97% of this amount within this 3 months period. And what you sell in March, 80% of this amount is collected in April, 17% in May, means it is also collected up to the extent of 97%. So, and now the last one. What you sell in Feb, 80% of this is collected in March beyond our time, and 17% is collected in April, which means 17% of this falls within the period we are considering, April, May, and June. Remember, this is the time period, the second quarter. So if you add all these 80% of 575 plus 97% of 450 plus 97% of 425 plus 17% of 500,000, your total is going to be 1,393,750. Okay, now again a long question, and what exactly is required. Total cash receipts for the month of April. For the month of April. Kermi company has been accumulating operating data in order to prepare an annual profit plan. Details regarding Kermi's sales for the first 6 months of the coming year are as follows. Jan, Feb, March and April cash sales are 20%, credit sales are 80%. Do not forget we need the cash to be collected in April, the total cash receipts in April. It further says if 20% is cash, 80% is credit. The credit sale has this collection pattern. 30% is collected within the month of sale, 40% 1 month after sale, and the remaining 25% second month after sale. If you add all these up, it will be 95%, and that means 5% remaining is not collected. So if this is the collection pattern, how much cash should we expect to collect in April? Remember, April sale 625, 20% is cash collected immediately. Remaining 80% which is credit, out of that credit 30% is collected within April. Done. What you sell in March, 80% is credit, and of that credit 30% is collected within March, and now we are going to collect 40% of this amount. And lastly, what you sell in February, 80% of this is credit, and of this credit 30% is collected within February, 40% collected in March. Now we are going to collect the remaining 25%. So the calculation is little twisted, but I am sure you would make sense out of it. 625,000, 20% represents the April's cash sales, 125,000. 625,000's 80% is the credit sale, of which 30% is collected within April. That's 150,000. Let me highlight these. Then March sales 700,000. 80% is credit, and 40% of this will be collected in April. It's going to be 224,000. Then what you sell in February, 650. 80% of this is credit, and now we're going to collect 25% of this amount. That is 130. So we just need to add up all these highlighted amounts and get our answer. 125, 150, 224 and 130 gives you a total of 629, and it perfectly matches with your option B. B it is. Historically, Pine Hill Wood Products has had no significant bad debt experience with its customers. Cash sales have accounted for 10% of total sales, and payments for credit sales have been received as follows. 10% is cash sales, remember, and 90% is credit sales. And of that credit sales, 40% in the month of sale, 30% first subsequent month, second month after sale, 25% second month subsequent to sale, and 5% in the third subsequent month. Okay, if this is the case and this is the forecast for cash for the sales for January to May, what is the forecasted cash inflow for Pine Hill Wood Products for May? For May. Okay. 85,000 is the total sales for May, and 10% of this will be collected immediately as cash sales. Mark this up. The remaining 90% is the credit sales, of which 40% is collected within May, because it says 40% credit sales is collected in the month of sale. And if we do the calculation, it's going to be 85,000 times 90% times 40%. It is 30,600. Done. Then what you sell in April, 90% is credit, and of this 90%, 40% is collected within April. Now we're going to collect the 30% of the amount, so it's going to be 80,000, 90% times 30%. It is 21,600. Okay, what about March sales? 90% of March sales is credit, and out of this credit sales, 40 is collected within March, 30 in April, and we will collect 25% of this as the collections in the month of May. So it's going to be 70,000, 90% is 25%, 15, and this is going to be 15,750. Last, what you sell in Feb, 90% of this is credit, and of this credit sale, 40 is collected within Feb, 30 in March, 25% in April. Now we are going to collect 5% of this amount, 65,000, 90%, 5% gives me 2925. 2925. If I add all these, I should get my answer. 8,500 plus 30,600 plus 21,600 plus 15,750 and plus 29,255 gives you 79375, and it should match with any of these options given. 79375 C. A company has a static budget at 10,000 units of production which shows direct material cost of $80,000. If $80,000 is for 10,000 units, that means on per unit basis it's $8 per unit. Direct labor cost is $60,000 for 10,000 units, so it means direct labor cost is 60 upon 10, that is $6 per unit. Why I am doing this on per unit basis, you will know. It further says factory overhead cost is 37,000, and out of which 40% is fixed and 60% is variable. If 40% is fixed, that means 37,000's 40% is 14,800. This amount is fixed. This is the fixed factory overhead, and remaining 60% is variable. 37,000 60%, that is 22,200. Now, since this is variable based upon 10,000 units, so that means your per unit variable cost VOH is 2.2. Remember, your material, labor and variable overhead cost can be given on per unit basis, and your fixed cost is given in total. Now the question says, at 6,000 units of production, what is your variable cost of production? Add this up, 8 plus 6 plus 2.22. Your variable cost of production is 16.22. So if you build up an equation for the cost function, total cost is equal to 14,800 fixed plus 16.22 multiplied by the number of units produced. X represent number of units. So this formula can help us establish the flexible budget cost for a certain level of output. At 6,000 units of production, a flexible budget would include which of the following amount as total production cost? 16.22 multiplied by 6,000. This is going to be your total variable cost for direct material, labor and overheads, variable. To this we add 14,800 as your fixed cost. It gives you 120 as your flexible cost, and that perfectly matches with your option B. On June 30th, year 1, a company is preparing the cash budget for the third quarter. The collection pattern of credit sales has been 60% in the month of sale, 30% in the first month after sale, and rest in the second month after sale. That would be remaining 10%. Uncollectible accounts are negligible. There are cash sales each month equal to 25% of total sales, and then 75% will be the credit sales. Total sales for the quarter are estimated to be July $30,000, August $15,000, September $35,000, and account receivable on June 30th were 10,000. What amount would be projected cash collections for September? Okay, now what you sell in September, it says 25% is the cash sale. There are cash sales each month equal to 25% of total sales. So 25% of this amount will be immediately collected as cash sales. Remaining 75% is collected is credit sales, and of this credit sales, 60% is collected in the month of sale, right? And the rest will be collected in October. Then remaining we have August sales. August is 15,000. Of this total sales, 25% is cash collected in August. Remaining 75% is credit, and of this credit, 60% is collected within the month of sale, August. Now we are going to collect 30% of this amount. And what you sell in July, 75% of this amount is credit, and of this credit, 60% is collected in July, 30% is collected in August, and now you're going to collect the balance, which of course will be 10%. So I'm going to write down now the numbers. 35,000 is 25%. It's going to be 8,750. 35,000 75% 60%. It is 15,750. Then 15,000 75%, and further its 30% gives you 3,375. And finally 30,000 July sales, 75%, and its 10% will be collected now, which is 2,250. Let me highlight all these. Add them up. 2250 plus 3375 plus 15750 plus 8750 gives you a total of 30125, which perfectly matches with your option C. The following information applies to Brendan Company. Purchases and sales are given for January till June. It says 40% of purchases are paid for in cash at the time of purchase, and 30% is paid for in each of the next 2 months. That means 40% in the month of purchase, 30% in the next month, and 30% in the second month subsequent to purchase. It says purchases for the previous November and December are 150 per month. Payroll is 10% of sales in the month it occurs. And operating expenses are 20% of the following month sales. And July sales were 220. Okay. Interest payments were 20,000 paid quarterly in January and April. It says Brandon's cash disbursements for the month of April were. So what you're going to pay in April, right here, outflows. This is the purchase in April, and you are going to pay as per the 40% immediately. So it means 40% of this amount will be paid in the month of April. So 140,000 is 40%. This is the first amount, $56,000. Okay. Then what you purchase in March, 40% is paid in March, 30% would be paid now. So it's going to be 160's 30%, and it's going to be 160's 30%, 48,000. Now what you purchase in Feb, 40% is paid in Feb, 30% in March, and now 30% will be paid in April. So it's going to be the same amount. 30% 160 is going to be 48,000. So purchase is done. Next item we have is for payroll. It says payroll is 10% of sales in the month it occurs. So your April sale is 300,000. So your payroll is going to be 10% of this amount. So it's going to be 30,000. And then we have operating expenses. They are 20% of the following month sales. Operating expenses are 20% of the following month sale, which means if your sale in May, that is the following month after April, if it's 260, you are going to pay 20% of this as operating expenses in April. So 260,000 times 20% is going to be 52,000. So this is the payment for operating expenses. And finally, the last item, interest expense, it says 20,000 paid quarterly, and the next payment is in April, so you are going to deduct this as well. So if you add all these, 48, 48, 56, 30, 52, and 20 gives you a total of 254,000. So total outflow in the month of April is going to be 254,000, perfectly matches with your option D. Clear Plus Incorporated manufactures and sells boxes of pocket protectors. The static master budget and actual results for May are as follows. Static budget was for 10,000 units. The actual units sold were 12,000. So we can't compare these. If we do, the resultant difference between this and this is going to be static budget variance. We are interested in calculating the flexible budget numbers. The operating income for Clear Plus using flexible budget. So what you will do, you will revise this budget up and draw up a flexible budget for 12,000 units. So what is the standard selling price? 10 multiplied by 12, so 120,000 should be the sales revenue. Flexible budget. Your variable cost as per the static budget is 60 upon 10, 6 multiplied by 12. Your variable cost should have been $72,000, which means your flexible budget contribution should be 48. Fixed cost cannot be flexed. You need to keep it as it is. And the net result is 18,000. So this 18,000 is your operating income using flexible budget, and that is option C. There is a shortcut which you can use directly by taking the budgeted contribution margin. 40 divided by 10,000, that is 4 per unit. So 4 multiplied by 12, 48,000. And from 48 deduct your fixed cost, you end up at the same number, 18,000. Operating income using flexible budgets. So that's C. Star Company is a retail store specializing in contemporary furniture. The following information is taken from Star's June's budget: sales, cost of sales, opening inventory, opening payable, closing payable. What amount should Star budget for the cash disbursements for June purchases? First of all, you need to establish how much have we purchased or will purchase using cost of goods sold, opening stock and closing stock. We know CGS is equal to opening stock plus purchase minus closing stock. CGS is given as 300,000. I'm just writing 300, omitting these zeros. Opening stock is given as 150 plus purchases. Closing stock is given as 180, making P the subject of this equation. 300 less 150 plus 180. So this is what we have purchased. This is not necessarily what we have paid to our suppliers. For this, you need to draw up your totals. Accounts payable account. Opening balance of accounts payable is 85,000. Closing is 75,000. And if we have made purchases for 330,000, the balancing figure here would be the cash paid. So it's going to be 85 plus 330 less 75, that is 340. This is what you are going to pay or will pay as per the calculation I've just shown you. It's D. Cab Incorporated, a small retail store, had the following results of operations for May. The budget for June and July are as follows. Sales are collected 80% in the month of sale and the balance in the month following sale, 20%. It further says goods contained in the cost of goods sold or cost of sales were purchased in the month prior to the month of sale, and vendor payments is made in the month following the sale, and all other cash expenses are paid in the month of the sale. Like what you sold in June, these items were purchased in May and the payment will be made in July. Likewise, what you sold in May, it was purchased in April, now the payment would be made in June. Cash disbursements for the month of June. Now this is now fairly straightforward. What you sold in May was purchased in April and now you will pay in June. So this would be the first outflow in June. And it further says all other cash expenses are paid in the month of sale. That means this 20,000 will also be paid. This 20,000, sorry, will also be paid in the month of June. So its total payment would be 41,000. So that should match with option C. A company has credit sales of 20,000 in Jan, 30,000 in Feb and 50,000 in March. The company collects 75% in the month of sale and 25% in the following month. The balance in account receivables on January was $25,000. What amount is the balance in account receivables at closing of March? Jan, Feb, March. 20,000 sales in Jan, 30,000 in Feb and 50,000 in March. This is the cutoff date, 31st March. And as per the information given, 75% is collected in the month of sale, 25% in the following month, which means this March sale, 25% remains uncollected at the end of the month March, which means 50,000 times 25% is still uncollected at the end of March, 12,500. And this will reflect as a balance of account receivable. What about Feb sale? 75% is collected within Feb, 25% March, fully collected. So it's only the March sale, 25% of it, which remains outstanding at the end of March. And this will reflect as a balance in account receivable. 12,500 is the answer. Now this is a repetition. What amount of operating income will Clear Plus have for May under flexible budget? We have just done this question as your question number 34. The answer is even the same, B. This is it. Question 34. The operating income for Clear Plus using the flexible budget for May is 18,000. Again a big question, but let us see what is the requirement. In April, Raymer's budget will result in excess cash or shortage of cash, which means we have to set up the cash budget and look at the requirement given. Raymer Company is preparing its cash budget for the month of April and May. The firm has established 200,000 line of credit with its bank at a 12% annual rate of interest, on which borrowings for cash deficits must be made in multiple of $10,000. If you need 17,000, you borrow 20. If you need 25,000, you borrow 30 in multiples of 10,000. There is no outstanding balance on the line of credit loan on 1st of April. Principal repayments are to be made in any month in which there is a surplus of cash. Interest is to be paid monthly. If there are no outstanding balances on the loans, Raymer will invest any cash in excess of its desired end-of-month cash balance in US Treasury bills. Raymer intends to maintain a minimum cash balance of $100,000 at the end of each month by either borrowing for deficits below the minimum balance or investing any excess cash. The closing balance should at least be $100,000. If there is a shortage, we will borrow. If there is a surplus, we will invest in the T-bills. It says collections are as follows. 50% of the current month sales are collected. 50% of current month sales budget and 50% of the previous month sales budget. Means the collections are whatever you sell in a particular month, 50% is collected in the same month, 50% in the next month. Information is given little differently. Accounts payable disbursement, 75% of the current month's accounts payable and 25% of the previous month's accounts payable budget. Okay, so now if you see here, what you sell in March, 50% collected in March, 50% in April. What you sell in April, 50% collected in April, 50% in May. And accounts payable, what you purchase, what have to pay, 75% is paid in the same month, 25% next month. And all other disbursements occur in the month in which they are budgeted. If this is the case, in April, which of these options would be correct, keeping in mind whatever we have done? So we are going to draw up a cash budget for for April. Our opening cash balance, as per the question, is $100,000 in April. What you sell in March, 50% is collected in March, 50% is collected in April. So 20,000 is collected in April from this sales. And April sale, what you sell in 50,000 in April, 50% of this will be collected within April, so it's going to be 25,000. No inflow. And then the payroll, it says, is paid in the same month. All disbursements in the month in which they are budgeted. So the 70,000 would be paid in April. Other disbursement, 30,000. Now regarding accounts payable, 75% of the current month's accounts payable budget and 25% of the previous month. So whatever was due in accounts payable in the previous month, 25% would be paid in April. 30,000 is 25%, 7,500. And in April, the payable is 40, and now we are going to pay 75% of this amount. 40,000, 75%. It is 30. And that's all. So if you add the opening balance 100, plus 20, plus 25, less 70, less 30, less 75, 100, 7.5 basically, and less 30, you have a closing balance of just 7.5 only. You have a closing balance of 7.5 only. So what you will do, there is a shortfall of your closing balance should always be $100,000. And how much short are you from $100,000? 90 to 500. Since we cannot borrow 90 to 500, either it has to be 90 or 100,000. So we have to borrow $100,000. We need to borrow $100,000 on its line of credit for the cash deficit. That makes C to be the correct option. Historically, Pine Hill Wood Products has had no significant bad debt experience with its customers. Cash sales have accounted for 10% of total sales, and payments for credit sales have been received as follows. 40% of credit sales in the month of sale, 30% in the first subsequent month, 25% in the second subsequent month, and 5% in the third subsequent month. The forecast for both cash and credit sales are as follows from Jan to May. Due to deteriorating economic conditions, Pine Hill Woods Products has now decided that its cash forecast should include a bad debt adjustment of 2% of credit sales, beginning with the sales for the month of April. Because of this policy change, the total expected cash inflow related to sales made in April. Since this change is going to take effect from April, so whatever you sell in April, it says 40% will be collected within April, 30% in May, 25% in June, and 5% will be collected in July. Since there is going to be a 2% reduction, So this collection will now fall to 3%. So the question, because of this policy, the total expected cash inflow related to sales made in April will be. Please note the sales made in April is $80,000, and as per the question's information, cash sales have been accounted for as 10% of the total sales, which means 90% will be credit sales. So $80,000, which is the sales in April, 90% of this is credit, and we are not going to collect 2% of this amount. Only the 3% and the 5% will be collected, 2% won't be collected. So $80,000 multiplied by 90% times 2%, 1440. 1440, this is what you may not collect in July as per the information I've given you. Decrease by 1440. Again, a huge question, but I always recommend to just look at the requirement first. The budgeted cash collections for the month of December. So for that we need the December sales or any account receivable balance as per this question here. Account receivable at the end of November year 1 is 150. Now the question says collections are expected to be 60% in the month of sale and 40% in the month following sale. Right? So what you're going to collect in December, you're going to collect 60% of this amount, 520,000, 60%, which is 312. And you will also collect what was due at the end of November, which happens to be 150. So 150 plus 312. Total collection in the month of December is going to be $462,000, and that makes D to be the correct option. A year 1 cash budget is being prepared for the purchase of toy, a merchandise item. Budgeted data is given as cost of goods sold, accounts payable opening, inventory opening closing. Purchase will be made in 12 equal monthly amounts and paid for in the month following. In the following month, you purchase in Jan, you pay in Feb. What you buy in Feb, you pay in March. What is the year 1 budgeted cash payments for purchase of toy? First, we need to find what is the figure for purchase. Cost of goods sold is equal to opening stock plus purchases minus closing stock. CGS given as $300,000. Opening stock is given as 30. Plus purchase, closing stock is 42. If you make P the subject of the equation, you will get 312,000. So this is the purchase we are going to make in the year 1. Now, purchases will be made in 12 equal monthly amounts. If you divide this purchase figure by 12, it means your monthly purchase is going to be $26,000. So if you draw up your accounts payable, you will know that the opening balance in accounts payable is 20. The total purchases that you will make over the period is 312,000, right? For which this $26,000 will still remain outstanding at the end of the year. Why? Because the question says so right here. Purchases will be made in 12 equal monthly amounts and paid for in the month following the month of purchase, for in the following month. So what you purchase in December, you pay in January. So this 26,000 will basically be the closing balance. This is the opening balance brought down. This is the total purchase. The balancing figure would be the total cash paid. So it's going to be 322 less 26. It's basically 332. Less 26 gives you a total of $306,000, and that's the total payment made. C is the answer. We have just done this question earlier, but now we need something else from this given information. In May, Raymer will be required to repay, pay, borrow what? We did the previous part and we established that there is going to be a shortfall of 90 to 500, and we had to borrow $100,000. So starting from that point onward, so our ending balance was 7,500 without borrowing. Let's say this is 7,500. The balance, let me show you what we did. So this was question 39. Please do this question 39 and the question we are doing right now, question 43. 39 and 43, they must be done together. So in question 39, we established that the closing balance is 7,500. We are short of 92,500. So starting from this point, this is basically when we combine April and May account of cash. So this is the starting balance you can assume to be at the start of May. And then we will add all the inflow outflow for May and see what is there is a total shortfall for April and May combined. So either you make a combined account of April and May, or you simply take the starting balance at the end of April and write up just the May's account. So 7,500 is the opening balance, right? What you sell in April, 50% is collected in April, 50% now will be collected in May. What you sell in May, 50% is collected in May, 50% in June. So 50% of this amount is going to be $50,000. Then what you purchase in April, 75% is paid in the month you purchase, 25% in the subsequent month, which means you are going to pay 10,000 of this amount in May. What you purchase in May, 75% will be paid in May, 25% in June. So 75%, this amount is going to be 30. Okay. Payroll, 50. And other disbursements, 10,000. Now, if you net all these off, you have a deficit in cash of 17,500, negative balance, overdrawn, in other words. More outflows and less inflows. Since we cannot borrow in 17,500, we have to go for the multiples. So we have to have a closing balance of $100,000, and for that we should borrow 120, because this 120 will neutralize this negative 17,500, and you will have a balance of, because we can't borrow 17,500, we have to borrow 20,000 to neutralize this and 100,000 to keep the minimum balance requirement. So we will borrow 120. So what the option is going to be, borrow an additional 20,000, pay 900, no, not A, it's going to be, so continuing with the previous month, May, from April, we had to borrow $100,000 because the previous balance was 7,500. So we had to borrow $100,000, which means even if we borrow $100,000, we are still short of cash at the end of the month, 17,500. So we will borrow 20,000 to neutralize this impact. And this 100,000 borrowed, we need to pay interest. And I hope you would remember the interest is charged at the rate of 12% per annum. So on $100,000, interest would be 12,000, right? 12% of 100,000. Since we are paying on monthly basis, so there will be 1,000 interest payment. So you will need to borrow 20,000 to neutralize this negative balance of 17,500, and need to pay $1,000 interest for the amount borrowed, 100,000, as per the question 39. Please do question 39 and 42 together, otherwise it will be difficult for you to understand. Rolling Wheels purchases bicycle components in the month prior to assembling them into bicycle. Month prior to assembling them into bicycles. Assembly is scheduled 1 month prior to budgeted sales. Interesting. Now let's say what you want to sell in June, you need to assemble in May and purchase in April. What you want to sell in July, you need to assemble in June and purchase in May. And what you want to sell in August, you need to assemble in July and purchase in June. It further says rolling pays 75% of component cost in the month of purchase and 25% of the cost in the following month. Component cost included in the budgeted cost of sales is as follows. Now listen, what is the rolling budgeted cash payments for components in May? This is the cost of sales for each month. What you sell in July, the cost of sales for July, it is assembled in June and purchased in May, which means this 8,000's 75% is paid in the month of purchase. 7,000, and then it is assembled in June and sold in July. Now, what you sell in June, it is assembled in May and purchased in April, and 75% of 7,000 is paid within April of the 7,000, and 25% will be paid in May. So 7,000's 25% will be paid in May. If you simplify and add the results, you're going to get 7,750. So this is the total payment made in the month of May, and that is going to be C.